Welcome to this video in which we examine and discuss the factors that may affect a company's capital structure, namely the mix of debt and equity that you'll see on the right hand side of the balance sheet. We won't just talk about that mix between debt and equity, but also the factors which may affect the cost of debt and equity towards the end of the video. For now, let's just state that typically our goal in the world of corporate finance is to try and, bring the weighted average cost of capital down. We typically also want to kind of match it against the useful life of our assets, the duration of our assets, so as to fund long-term assets primarily with long-term capital sources like equity or long-term liabilities. Beyond that, there are other factors at play, and the number one factor, or factor number one, it's not necessarily the primary factor, but factor number one, which affects the mix between debt and equity that a company may have, is the business model that it is running. Or actually, this is a factor which kind of drives how much capital in the first place a company needs. Maybe that's the best way to put it. So the business model, your curriculum talks about sort of two business model types. One are capital intensive businesses, and those are obviously going to be the ones that require typically lots of assets, So think about companies from sectors or industries like utilities, power plants, waterworks, that kind of thing, sewage plants, transportation, shipping, airlines, railways, real estate. Of course, buildings are capital intensive. These types of industries or these types of businesses will be spotted by relatively low asset turnover in relation to their sales, and relatively high capex, capital expenditure, in relation to sales. Now, having said this, right, if you look at things historically versus now, well, historically a lot of industries were vertically integrated, so there was a lot of so-called vertical integration where you would try to handle all the steps in the production process sort of from raw material to end product under within one business, whereas today what tends to happen is a lot of the capital intensive or asset heavy segments of that whole production chain are outsourced to external businesses, external companies. So often the capital intensive business is running as a separate company, and just to give you, a very sort of book-inspired example, hotel franchises. Most of the world's big hotel franchises don't necessarily own the real estate. The hotels, they just own the hotel franchise, but this is absolutely separate from the hotel building ownership, just like McDonald's isn't sort of the owner of the McDonald's restaurants, right? Those are owned by completely different businesses. In the same way, if you think about companies that design and manufacture chips, semiconductor chips, right? Chip design by companies like NVIDIA or Intel is absolutely separate from chip manufacturing, which happens at specialist plants that handle production for a lot of different chip designers and chip companies. therefore requiring NVIDIA or Intel, not requiring NVIDIA or Intel to make those, to keep those capital intensive assets. Right, so let's also state that sometimes the actual capital structure of a business, namely the proportion of equity that it uses in relation to debt, is subject to regulation, so is sometimes regulated, and that for sure is the case at banks. Banks typically have certain capital or equity minimum requirements which stem from international regulation under rules called Basel rules, and sometimes utilities companies in some countries are also required to have a certain minimum level of equity in relation to their overall capital structure. Right, so these were capital intensive businesses. And of course, in opposition to them, we're going to have capital light businesses, or businesses that do not require that much capital. So capital light, or as your book also calls them, asset light businesses. Okay, now these are typically associated with, for example, the service sector, technology companies, where often the assets are things like cash or intangibles, knowledge-based assets, that kind of thing. These companies will have relatively low capital needs. So let's think about examples of such businesses, such industry sectors, but also the reasons why certain businesses may not necessarily need a lot of capital. They may, for example, be operators of networks where the assets themselves are owned by others. So assets are owned by others. And that could be the example of a hotel network, the one that I mentioned, something like Hilton, right? Doesn't own the hotels, they own the franchise. Somebody else owns the hotels themselves. From, let's say, more modern companies, something like Uber, right? The taxis or the cars are owned by individual owners, not Uber themselves. They run the technology. Airbnb is another example of the operator of a network where the assets, the properties are actually owned by, once again, individual owners. Another bunch of reasons why companies may have low capital needs, your book mentions quite a few of these. Now, that doesn't mean they are necessarily asset light, right? They just don't need a lot of capital as such. Could be because these businesses charge their customers quite a lot of, for example, upfront fees, and hence do not need, let's say, additional external financing to this degree, or have a negative cash conversion cycle. Now, the idea of a negative cash conversion cycle is quite interesting. I would typically associate this with running some kind of supermarket chain. If you're getting stuff delivered to a supermarket chain, providing you're a big chain, so probably your supplier, delivers stuff, but you don't pay the supplier that soon. You've probably negotiated quite an extensive period until the supplier is paid. So payment made to the supplier, and that would be your negative cash flow. In the meantime, the stuff is already sort of on your shelves in the supermarket, so maybe it's there for a couple of days. The customer buys the product and typically pays for it immediately using cash or pays by card, in which case, the payment is received over here a couple of days later onto the supermarket chain's account. Payment is received, and you essentially get cash from customers quicker or sooner than you pay or than you suffer the outflow of cash towards your suppliers, and that's your negative cash conversion cycle, or a negative liquidity gap, which means you have very little need here for external funding. You don't need so much external capital. You finance this using the negative cash conversion cycle. Right, what else? Some businesses don't really need to raise a lot of funding from outside because they compensate their employees as well as management. Obviously, management are also employees, with stock-based compensation rather than paying them wages in actual cash. So that way, there is less need for liquidity in the business. This is obviously very typical, for example, for startups. One way which they limit the need for external capital is to pay employees using stock-based compensation, stock options, for example. And technically speaking, this is going to be equity funding, but provided by the employees. They provide the work in return for equity instruments. Technically, that's what it is. And you could say it's external because it's equity, but it comes from employees, so you kind of think about it as being internal. And one additional idea which may limit a company's need for capital, which doesn't necessarily mean it's an asset-light business, right, is if you imagine an early stage company, so a kind of startup, which already at its early stage is profitable. Now, most startups will not be. And actually here you would also have to add that it is also asset light. Such a business wouldn't really require too much external funding if it meets these conditions, that it's already profitable at the early stage and it's asset light. So these are this is kind of the business model related factors that may drive a company to require more or less capital. It's not really about yet which type of capital, which type of funding you're going to need, but how much of it you're going to need, how much of it you're going to require from outside. So let's jump on to factor number 2, and that is the stage which the company is at in what we call the corporate life cycle, where the corporate life cycle is kind of that axis where companies move from being startups to being sort of in their growth phase and then being mature companies in the end. And here, this is going to have indeed a very big influence, not just on the size of the funding needed, but primarily on the type of funding. So this is where we will have an opportunity to discuss more, is it more equity, is it more debt at different stages. Now, at the startup phase of a company's life cycle, every company has to go through some, initial, startup phase. What's this? Right, I seem to have changed the thickness of my pen. So when a company is, that's also too thick, let's drop it to 1. When a company is at the startup phase, it has zero revenue yet, typically. It's working on a product, and it's moving towards, some initial positive revenue, but this is still initial. In terms of cash flow generation, it doesn't really have any free cash flow at all. That is cash which may be spent on things like the repayment of debt. Its cash flow is negative, free cash flow from operations once you consider the investments needed. And there is a very big risk still of business failure. So that risk remains elevated. It's high, definitely, which is why, right, at this stage, you're typically going to be funded only by equity, and that equity will not come from public markets. It's going to be equity from the founders who commit money into the business, employees possibly if they accept payment in the form of stock or stock options, stock-based compensation. Of course, VC venture capital investors provide capital at this stage, equity capital at this stage. But as I said, you wouldn't go typically for a public listing at this stage. Why? Because it's very expensive to run and even to carry out. Even if you're doing a relatively small IPO, it's still quite costly. Very often the sort of the serious stock exchanges where you may choose to list have certain minimum requirements with regard to revenue or profitability of the business, its size, and you may not be at that stage yet to make this a viable option. Now, what about the availability of debt? Debt funding is typically limited at this stage. So let me write this down. Debt funding limited, because you don't really have free cash flow to be, repaying debt. However, limited, but let's say limited to just a few opportunities. Leases of assets, like leasing real estate or leasing some maybe some office equipment, right? You don't own it, you lease it, so you kind of rent it out. And what may be available is convertible debt. Now, convertible debt is debt where the holders of it, the debt holders, may choose to convert that debt into equity at a predetermined sort of conversion rate or a predetermined price. So they give you debt financing and they may require that money to be repaid, but if they see that the business has gone really well, they may wish to convert the debt to equity, and typically, so they leave themselves that upside there. However, this kind of debt is still quite risky because it typically has all the interest shifted or deferred until the maturity date. Otherwise, a company may not be able to pay that interest because it doesn't really generate any cash flows as such yet. So this is the kind of debt you may be going for at this startup phase. Now, the next phase in a company's life cycle could be described as the growth phase. Okay, the growth phase. This is where the company, is experiencing rising revenue growth in the sense that revenue is growing, but at a rising pace. The trajectory is definitely upward sloping. Free cash flow generation is also improving. It's going typically at this stage from negative free cash flow, where you're eating up more cash than generating, to positive, which makes the servicing of debt a bit more realistic. Business risk subsides at this stage, so business risk goes from a previous level of high to something lower, let's say medium. It's not low yet, but it's moderate. And in terms of the availability of debt funding, that's definitely improving. It's increasing, especially if a company wants to go for secured debt issuance. Those options typically become already available, but it's important to stress that even though the possibilities to take on debt are improving, you're still relying mainly on equity funding as the primary source. And the final stage that your book talks about is the maturity phase, or the mature phase, where the company is already sort of a grown-up, stable business. And in terms of its revenue growth, the dynamic is not as spectacular as before. It's typically slowing at this stage and stabling. Free cash flow generation is also stable. And these companies typically, become your classic sort of cash cows, a business that just churns cash flow out in a very predictable way. The business risk at this stage will typically be quite low. And that means providers of debt will be eager to lend to you at this stage. So the availability of debt availability, is high now. And, also primarily includes unsecured debt because of the much lower risk associated with your business. And what companies do at this stage is they typically consciously start sort of changing the proportions between debt and equity. So what they sometimes do is they borrow money, especially when interest rates are quite cheap, and they use that money, for example, to effect things like stock buybacks, so as to reduce the amount of equity outstanding and pile on additional debt. And that has the effect of optimizing WACC, weighted average cost of capital, bringing the weighted average cost of capital lower. They obviously also start paying quite big dividends to shareholders, essentially giving back money to shareholders, but often piling on debt. Right. In the final section of this sort of reading, or this section of the reading, the curriculum talks about the actual cost of both debt and equity, and what the factors affecting the cost are. So what are the determinants of the cost of both types of funding? And they talk about two factors here. One bunch of these factors are going to be sort of factors that influence all issuers. So they are not specific to an issuer, they influence everybody. So they are so-called top-down factors, as your book calls them. And they basically derive from general financial market conditions, as well as conditions being experienced by a given industry, right? But they are not issuer specific. So as you will know, if you've already studied, for example, fixed income, when it comes to the cost of debt, as applicable to corporations, to companies, what we typically focus on are interest rates on sovereign bonds, or yields on sovereign bonds. And depending on the level of the yield on sovereign bonds, which is hugely influenced by what central banks are doing in their interest rate setting, we typically add a premium to this. And this, whatever level is here, sets the yield or the required rate of return on corporate instruments, on corporate debt. Now, of course, central bank policy affects that base rate, that benchmark, the level of rates on, let's say, sovereign bonds, on treasury bonds. The premium, on the other hand, we often say it's issuer specific, but that premium increases as conditions deteriorate in the economy, as it becomes more likely, let's say, that issuers generally will get into trouble. And it's actually higher also for companies in industries that are deemed to be cyclical, in cyclical industries like construction, for example. So industries whose performance varies hugely across the different cycles, stages of phases of the business cycle, right? What else? I mean, we talked about industry conditions, and some industry conditions will be hugely impacted by some external factor. For example, the price of crude oil. The oil price will affect oil producers. When the price of oil goes up, they've got much bigger profit margins. When it goes down, they suffer. Quite the reverse situation, for example, for airlines and the transport industry. So these kinds of top-down factors that are not necessarily company-specific, but market or sector-specific, are going to play a huge role in the cost at which companies can borrow or can issue equity. And there are, of course, quite a lot of issuer-specific factors above that as well. So, your book lists a couple of these, and it's a good idea to know them because they're quite sort of sensible, they're quite intuitive as well. Number one is sales risk, right? Is your company or is the company, or are the company's revenues stable? Relatively predictable? Is the growth rate quite, let's say, is the growth rate stable? We're not looking for stable revenue, but stable growth. So stable, predictable growth of revenue, right? That's what we look for typically if we want to provide funding to somebody, and that will definitely drive the cost of funding down. Does the company, and this is something we like, have a diversified customer base? The more diversified the customer base, the smaller, the weaker the power of the buyers here. And it's, if you've got a very diversified customer base because you're selling to retail clients, lots of individual retail clients, your position as a seller is quite strong typically. And this is what we like. And we also like when a company has lots of recurring revenue. And we love it when it's subscription based in the sense that, it's repetitive. Obviously, not everything can work in this way, but, companies in the telecoms industry, for example, have recurring revenue where we pay on a monthly basis. So do streaming platforms like Netflix. That provides some stability. What else? The profit, what your book calls profitability, risk. This is an important one, although the name can be misleading. The way we typically measured this, so this can be or may be measured using a metric known as operating leverage. What's this? This is the ratio of fixed costs to total costs. Of course, in the cost structure of a company, certain costs are fixed, certain costs are variable. And of course, the more a company is loaded with fixed costs, the more risky it is because it will have higher operating leverage. A higher level of operating leverage is something very dangerous because as revenue changes or as revenues of the company go up or down, if a company is highly operationally leveraged, its profits will be a lot more volatile, obviously in the same direction. If your revenues go up, your profits can go up a lot more in the sense of a percentage change because most of your costs are fixed, so there isn't the need to load up and suffer more costs. But if revenues fall even a little bit, a company that has a high proportion of fixed costs will typically, from a profit perspective, suffer immensely because most of those costs cannot be switched off. You still need to incur them, irrespective of the fact that your performance, your revenue performance, isn't that good, right? Now, a third let's say, issuer-specific factor is going to be the issuer's existing level of financial leverage and interest coverage. So what we're trying to get at over here by saying financial leverage is basically how much existing debt the company has, level of existing debt. And if a company already has significant levels of existing debt, obviously it has a lower, I guess, ability to take on and support additional debt or incremental debt. And that additional debt will therefore be more risky and you'll have to pay a higher price for it. We are, after all, talking about what can increase or what can drive the cost of debt for an issuer. But if they've got significant levels of financial leverage already, taking on additional debt will be more costly. But also it becomes quite risky for equity investors. Equity investors are not immune to this effect either, because the more debt a company has, the higher the amount of what are, after all, liabilities, and liabilities represent in the sort of hierarchy of who gets paid first in case of liquidation. Liabilities towards debt holders rank higher versus equity. So the more leverage there is, the more debt there is. It's not good for equity investors. They will also demand a higher rate of return. So the cost of equity will go up because there are higher priority claims in the hierarchy ahead of the claims of equity investors. Interest coverage, if you are asked to compute this, please appreciate that it is the ratio of profit before interest and taxes. So kind of the level of EBIT, earnings before interest and taxes, over interest expenses for the period. What we're trying to see here is the extent to which profits generated from, let's say, the business can cover interest payments. And the higher this ratio is, of course, the better from the point of view of, let's say, from a risk perspective. And the fourth and final factor that your book wants you to consider is the availability of collateral and the type of assets owned by the business. If you want to reduce the cost of debt, always think about providing collateral. Sometimes you'll have to provide collateral to get a loan in the first place. And if you're issuing bonds, it's cheaper to issue bonds that are collateralized, secured rather than unsecured. Typically, providers of debt like assets that are tangible. There's something concrete, cash generating, liquid. It's not always possible to find all of these, let's say, conditions being met. But if you've got, let's say, good quality real estate, that will support to a greater extent the use of debt in your balance sheet. Whereas if you've got just intangible assets, nobody will really treat that as serious security or collateral for a loan, and you'll have to rely more extensively on equity funding.